Good evening, everybody. Sorry for the late. We're going to talk about US dollar correlations with gold and silver, precious metals, and what we are going to expect from it. So it seems that everybody is seeing and hearing me clearly. So we'll just get a head start and with our conversation today about gold. But before we start this, I do want to know why you're here today. Why do you want to know more about gold? Are you a gold or silver trader, or you just want to know about the correlation? So in the chat box, please do go ahead and type in what your expectations are from today's webinar. This is a live webinar, as I said before. So type in why if you're a gold trader. All right, we do have some people who trade gold. All right. And type in a why if you have never traded gold. All right, we have both gold traders and non-gold traders. That's awesome. So with that, I think, yes, so today we have a very mixed crowd, so we're going to talk about how to trade gold and silver now. And if you are not a gold and silver trader, we're going to talk about how gold and silver is correlated with, well, not only US dollar actually, but any other Forex crosses. But, well, the biggest correlation between any currency and gold has been seen with the US dollar. And the reason for that is basically because you know, the gold and US dollar were associated when the gold standard was being used, and during that time the value of a unit of currency was tied to the specific amount of gold. And this is a long time ago. The gold standard was used from 1900 to 1971, and the separation was actually made in 1971, and the US dollar and gold were freed. And now they're basically valued based upon supply and demand, and gold is a commodity, and the US dollar became the fiat currency, a currency that gets its value from government regulation, right? And but it's not actually backed by a physical commodity, right? And so the U.S. dollar, one thing that you need to know about the U.S. dollar on this topic is that it is a reserve currency, right? So now gold started to become a floating exchange in 1971, and it made its price since then very vulnerable to the U.S. dollar's external value. And in 2008, in fact, the International Monetary Fund, the IMF, estimated that 40 to 50% of the moves in the gold prices since 2002 were dollar related. And so we can basically say that, as you can see here in this graph, that there is an inverse relationship. At least it had been. There was an inverse relationship between gold and the US dollar up until, well, let's say 2014. And now it's starting to change a little bit, so we're going to talk about that. But let's get the history down and see, because if we get the history straight, then we can, well, have a better prediction of the future, even though things are not quite similar as before. So this chart shows that the trade-weighted US dollar and the gold and the price of gold are inversely correlated, and the trade-weighted value shows how the US dollar is gaining or losing purchasing power compared to its trading partner. So this is a US dollar index. This is not a specific currency pair. We're going to get it into current dollar crosses later, But for now, this is what a US dollar index and gold prices index looks like. But as you can see, the inverse relationship isn't as precise as it used to be under the gold standard. Even though the gold standard is gone, there is still a psychological tilt towards gold whenever the value of the US dollar decreases. The inverse relationship, however, we can expect it to remain because a falling dollar increases the value of other countries' currencies. And this increases the demand for commodities, including gold, and so it also increases the prices. And also, when the US dollar starts to lose its value, investors look for alternative investment sources to store value. And gold is definitely an alternative because, well, historically, gold was the currency to trade. There were no greenbacks or currency pairs. Everybody was trading gold coins. So it is important to understand that it is possible for the US dollar and gold price to increase at the same time. And this can occur because of a crisis in some other country or region, and that would cause the investors to flock to a safer asset, which means both the US dollar and gold, right? And so the US dollar itself is driven by so many other factors like the monetary policy and inflation, and interest rates, and US versus other countries' relationship, and politics, and so many different factors, right? And while investors, when they're trading the US dollar, they obviously have to consider all of these factors. So one more thing about gold, for those of you who have never traded gold and are wondering how you can trade gold, well, there are different indices. You can trade gold as a stock, like Gold Corp Inc. or GG, the symbol is that for it, or Barrick Gold Corporation, which is ABX, or Newmont Mining Corporation, which is NEM. And also you can trade gold as an ETF. But you can also trade gold versus the US dollar on a currency platform. And so can you also trade silver versus the US dollar. We'll get into that in a little bit. But first, let's talk about what happened to the dollar-gold correlation in the past year. So, well, a lot of people, they base their trades based on a correlation between different markets. And the understanding is that when one market moves in one direction, we should see a correspondingly opposite move in an inversely correlated market. So for example, we've covered this before, Canadian dollar and oil prices are inversely correlated most of the time. And their correlation is very close to perfectly positive. And many have used the bond market in such manner in relation to the equity market. And also many have used the US dollar relative to the gold market. So it's not only the forex traders who use this. But one of the biggest issues with using this kind of seeming correlations is that they disappear just as quickly as they appear. And when the markets seemingly are in a correlation, and that is when the analysts are like, okay, what happened? And they don't understand what's going on. And there's so much more noise out there. A lot of people already know about this correlation. So the market sentiment, the more people know about these kind of correlations, the more the correlation actually doesn't work. Because let's say the US dollar gets stronger, so everybody can say, oh my God, so because the US dollar is getting stronger, gold prices are going to go down. And everybody goes and sell gold. And that is going to actually create an issue with gold prices, because there's a lot of demand for it now because because they saw that the US dollar is going stronger, everybody's buying gold, the demand is going higher, and that is going to eventually actually make the gold prices to go higher. So be very careful when it comes to listening to market noise and what people are saying. So after many QE programs, quantitative easing, well, the US dollar goes lower, for example. But since 2011, we have seen this correlation with gold kind of dying away. And so with that, it is very easy to say that, well, that is only a 3-month period of time, for example, so no one can really make any decisions based upon that perspective from a pure relative time frame. And I would not argue with you on that. However, when the dollar goes through the most parabolic upside moves we have seen in years, at the same time that gold also rallies 14%, you cannot simply ignore this kind of move because it happens because it happened within a short period of time, especially if you're a day trader, and you can blow up your entire account being wrongly positioned on a move like that while hoping for the old correlation to apply, even if this is only within a 3-month period of time, or well, even worse, like a 1-day period of time. So when you're trading gold and silver, well, we'll get into silver in a little bit, but when you're specifically trading gold based on the correlation to the US dollar, and I think coming up in June, for example, we're going to we're anticipating a Fed rate hike, and with that we're anticipating a raise in the US dollar value, and vice versa. If they don't hike the rates, we're expecting a fall in the US dollar value. And if you're a gold trader and looking for that speculation, for that event risk to either buy or sell gold, be very careful with your stop loss and exit strategy, because this can actually create a panic sentiment that may not be correlated to the direction of the US dollar, as a lot of people obviously trade gold based on the correlation. And the point I'm trying to make is that the correlation comes and goes with any warnings, and unless you have the tools to be able to predict when those seeming correlations will cease, you'd better know how to use the stops on all your trading and investment instruments. Otherwise, you will be left holding a bag full of losses while scratching your head and wondering what happened. It is for this reason that I always suggest all my students to analyze each market on their own, for their own merit, and to not really rely on any seeming correlation or intermarket analysis as a heavily weighted tool in your investment. It is always good to look at it because, of course, historically this has been there, but don't make that your only method of strategy building, and put together a technical and analysis, as well as your well-developed risk management to do so. So one thing that you need to understand about buying gold is that, well, obviously when you buy gold, you're actually just selling dollars. And so in the years that being long the gold and being short the dollar, which was actually the beginning of this year, were basically the two sides of the same trade, especially when the correlation is higher or is more strong. And well, actually in beginning of May this year, the gold and dollar index hit the highest and the lowest levels in 15 months respectively. So gold hit the highest level and dollar index hit the lowest level, and over in the daily moves of gold and the dollar index, they started to show the inverse correlation again. So actually the correlation before that was falling all year, and then it kind of came back. And I think I actually attribute this to, people up until 2014, let's say, the correlation was pretty strong, so everybody was talking about it. And then people started noticing the correlation getting weaker, and they stopped trading gold based on the correlation. And with that, as I said, when less people use the strategy, the stronger actually the correlation gets. So it's basically a very interesting factor, and it's kind of like there is no win for that. And because people were starting to pay less attention to the correlation started to get strong again. So these are all the points that you would want to keep in mind when trading gold. So now let's talk a little bit about silver prices and the correlation. And I also would like to talk about the silver prices with the Aussie dollar. Not the US dollar, but also the Aussie dollar. So first, starting with the value of silver versus the value of the dollar. When you trade your dollars for actual gold and silver, that is basically when you're not very confident in the US economy. And silver is very similar when it comes to movements to gold. And a lot of times when the Dr. Dooms of the world come out and say, oh, the U.S. economy is completely going down, they've really forced you to buy gold. And I always say that there could be an agenda. They just want to sell their gold to you. But the bottom line is that the gold by itself, if like we go to a different planet and we show them our US dollar or gold, well, yeah, gold is shiny, but they won't know the difference. The gold by itself is not essential to your living, right? You understand what I'm saying? It's not water, for example, as a commodity, or it's not oil as a commodity. You can't actually use gold, so, or silver, right? So for that reason, I really do believe that gold and the US dollar shouldn't actually be that different in actions, right? So with the global, when the economy slowed down in China, though not many people obviously think that way. When the economy slowed down in China in the beginning of the year, the demand for commodities and precious metals like gold and silver have been under pressure. And so the reason why I brought the Chinese slowdown is because, as I said, I wanted to talk about the Aussie dollar a little bit. So the Aussie dollar is a little bit different than the US dollar in a sense that Australian dollar is among the top silver producers. Australia actually is among the top silver producers in the world. So any volatility in the commodities price globally have an impact on the value of the Australian dollar against the US dollar. So this is one of the most interesting correlations of gold between commodity, precious metal commodities, and a forex pair, because when you're trading forex, you obviously want to pair a strong currency with a weak currency, because that will give you the strongest push towards whichever direction the quote currency is moving, right? And so looking at the price of silver futures and the value of Australian dollar, let's say for 2 months, the correlation was about 0.65, which is a good correlation. It's not perfect, but it's still a very good correlation with that. So what I'm trying to say here is that when the precious metal prices are down, it is a good chance that the Australian dollar prices are also down. And well, just look, there is a little bit more fundamental base to it than just a US dollar and gold correlation. So we have a weak Australian dollar together with a strong US dollar, and together with let me actually bring up together with the so we have a weaker precious metal, which also affects the Aussie dollar, and then because of the semi-positive correlation between US dollar and semi-negative, I'm sorry, a correlation between US dollar and gold, that would increase the chances of the Aussie dollar pair to go lower down. All right, so to just give you a cheat sheet on well, the commodity prices and the US dollar. So basically what you need to keep in mind is that, well, just if you're looking only at the correlation, so correlation, when gold prices go up, more often than not, at least not in the short-term trade, but in a longer-term period, you see the US dollar to go down. And the reason for that is that during times of those economic unrest, investors tend to dump their dollar in favor of gold. And the reason behind that in their mind is that, unlike other assets, gold maintains its instinct value. I don't agree with that, but that's what they say. And so when it comes to currency pairs, right, so let's go to currency pairs, US dollar crosses, right? So let's start with Aussie dollar that we just spoke about. When the Aussie dollar, when gold prices go higher up, you can see Aussie dollar prices to also go up, and vice versa. So let's take a look at this right now. So we have the Aussie dollar pair has been on a downtrend. This is the daily chart, right? And actually I can bring up our Orbex daily chart over here. So we have the Aussie dollar going down, and then if we take a look at the symbol for gold versus US dollar, which is XAU dollar. Oh, these all come in. So we're going to do the Forex. As you can see, at least right now in the past few months, they sort of have had a positive correlation. So since, this is the daily chart, right? So since beginning of May, we've started seeing the gold prices versus the US dollar going down, and same as what we saw in the Aussie dollar. But the correlation, as you can see, between the two is not really perfect. I apologize, this is a little bit too messy, so I'm going to create a new chart of Aussie dollar so you have a better view of what I'm talking about. So let's take a look at the correlation, right? So since April, that is when the Aussie dollar first started going down, whereas the let's bring it up over here, whereas well, actually no, it's pretty similar, right? The bottom over here was in January 19th, 2016. That is when all the gloom and doom happened with China, and gold actually got hit a little bit earlier, right when Chinese data was, before the Chinese data was really taking over the market. And so it's pretty much a very positive correlation. So the strongest correlation when it comes to currency pairs and gold prices is between Aussie dollar and gold. And let's also take a look at silver and see what the correlation is, right? So if we take a look at silver, which is XAG versus the US dollar, you can see that it's almost identical to that of gold. So I'm not going to bother to show both gold and silver. They're pretty much the same, and the way you want to trade it, obviously diversification is key. And if you're a gold and silver trader, I wouldn't recommend having too many positions on both. So you want to do one at a time. There is a little bit of a difference between the two, but the overall movement is basically the same. So for those of you who do trade gold and silver, what is the time frame that you trade these commodities? Do you day trade, or are you more of a longer term gold and silver trader? You can go ahead and type your answers in the, okay, so I'm getting more longer term. So that's perfect. So with that, you definitely don't want to be too precious metal heavy, especially when it comes to silver versus the US dollar and gold versus the US dollar, because they both basically move in the same direction. And if you're wrong with your analysis, you don't want to be wrong twice. Of course, if you're right with it, well, that obviously also depends on your risk appetite and your other positionings with other currencies. But as you can see, gold and silver really do trade in the same way. So we talked about gold versus US dollar and Aussie dollar. Next, I would like to take a look at Kiwi dollar, right? And see how that one pans out. So again, Kiwi dollar has the correlation is a little bit weaker than that of Aussie dollar, because New Zealanders, they rely less on commodity exports and they rely more on dairy products. But well, New Zealand actually ranks 25 as the large producer of gold. So that's why the next best bets, basically, when it comes to gold and forex correlations after Australian dollar is Kiwi. And then again, if we take a look at both of this, we started again January 19th is when the Kiwi dollar found the bottom, same as Aussie dollar. And taking a look at what happened in gold, well, gold found the bottom a little bit earlier, back in December, and actually in January it started going back up. So there was a little bit of a delay between the correlation, but then they both kind of started going up. Kiwi dollar started moving up in a channel, in an upward channel, as you can see. Let's be more clear about that. So this is our upward channel. Oops, this is not our upward channel. Our upward channel is from here. Right, this is a little bit tighter, but so this is our upward channel that the Kiwi dollar started moving up, while gold versus the US dollar was a little bit more rapid when it comes to the up moves, and then it started its own channel over here, and it started to do a pullback, as we can see as of today. As the US dollar is getting stronger, obviously gold is again showing the correlation, as I said, and let's see, with Kiwi dollar it's actually consolidating, but so the correlation is not as severe when it comes to Kiwi dollar. Next, we're going to talk about when gold goes up, what happens to, let's say, dollar Swissy. So here's the difference between dollar Swissy over here and Aussie dollar, let's say, or Kiwi dollar. What you have to keep in mind is that with dollar Swissy over here, the US dollar is quoted first. So the stronger the US dollar gets, this pair would go up, while with Aussie dollar and Kiwi dollar, US dollar is quoted second. So the stronger the US dollar gets, the pair will go, what's the answer? Down, right? So with dollar Swissy, let's bring up the chart right over here. You need to know that 25% of Switzerland's reserves are backed by gold. And so for that reason, when gold prices go up, the dollar Swissy will go. Who knows the answer over here? You can type your answer. When dollar goes up, what happens to the dollar Swissy pair? That's correct. Dollar Swissy will go down for two reasons. Not only we have the US dollar by its own, having the inverse correlation with gold, but also Swiss franc has bought more when gold prices are up. So we get a stronger, so we get the, I'm sorry, so we get a weaker Swiss franc and a stronger US dollar. What am I saying? Let's look at the example one more time. So we're talking about gold prices. Let's actually write it down right over here so we don't get confused. So we're talking about gold prices going up. Let's do this over here, right? So to make it more visible, when gold prices go this direction, when gold prices go up, we will have US dollar versus Swiss franc to go down. That means we're getting weaker US dollar because gold prices are getting stronger, and a stronger Swiss franc. which will ultimately push this pair down. Let's actually have this same format for all of it. So while gold prices go up, the Aussie dollar pair will go also up, right? And when gold prices go up, the Kiwi dollar pair would also go up because our US dollar gets stronger and our Kiwi, which is the 25th biggest gold producer, gets stronger. So how about Canada, Canadian dollar? What happens when gold prices go up to Canadian dollar? Well, if you're talking about the dollar CAD pair, first of all, well, the general understanding as we covered is that gold and US dollar have inverse correlation, so we would expect that when gold prices go up, US dollar itself gets weaker. But also, Canada is the 5th largest producer of gold in the world. So as gold price goes up, Canadian dollar tends to get stronger, which will ultimately push this pair as well higher. So in terms of ranking, we had Australia as the 3rd biggest gold producer and Canada as the 5th largest producer. And so actually we might want to put this a little bit higher up, right? And then we also had talked about, we're not going to talk about oil, but Canadian dollar has an very positive correlation with oil as well. So because Canada is one of the top oil producers in the world, exporting around 2 million barrels of oil a day, and so oil and gold both have an inverse relationship with the dollar CAD pair. I guess we got a question over here. Yep, so we're getting a question from Veronica. When gold prices go up, dollar CAD prices go. I'm sorry, yes, I did make a mistake. Oh, I'm a little bit out of it today. Thank you so much for pointing that out. That was my mistake. I'm sorry, I've been saying it, but the arrow wasn't looking at the. Let's actually go over it one more time. Gold price is going up. Dollar Swissy goes down. This is correct. Aussie dollar goes up. This is correct. Kiwi dollar goes up. This is correct. And dollar CAD goes down. What about euro dollar? This one should be easy. I need to bring this a little bit lower so we don't have this kind of. So we have Aussie dollar, Kiwi dollar, dollar CAD. How come I got here again? Oh, I'm sorry. So this is gold. We have gold over here. We have dollar Swissy over here. We have Aussie dollar going up. We have Kiwi dollar going up. And we have dollar CAD going down. And when it comes to euro dollar, both gold and euro are considered anti-dollars. So when, well, price of gold goes up, the euro dollar may go up as well. And actually, this has been pretty strong recently in the opposite direction, right? Because if we take a look at the price of euro versus the US dollar, which has been going down, right? Since it hit 115, we also had gold prices going down. So as you can see, euro dollar with gold, but comparing to gold versus dollar, also have a positive correlation. So for those of you who are looking at gold and silver for kind of an indication of trading Forex, this is what you can keep in mind. But again, not too much, because sometimes the correlation is not complete or completely positive, right? Or negative. But for those of you who trade gold and silver, what are we going to expect next? That is a big question that we're going to answer. So what are we expecting from gold on a US dollar basis? Well, that is exactly what we're expecting from US dollar, but in the opposite direction. So right now with the US dollar, we are expecting a rate hike from the Fed in June. And because of the speculation right now, the US dollar is getting more and more stronger. However, if the Fed doesn't raise the interest rates in June, that is going to have a backslash from investors, in which case the US dollar will start pulling back, so US dollar would get weaker, and with that we can expect a correction in gold. So technically speaking, let's see what's going on over here. We've had an interesting year when it comes to gold. We've seen this cycle. Gold prices hit a top. It reached a high of 129, right, versus the US dollar right at the end of April. And then the Fed came and they had this confidence, and we had better than expected inflation, and US dollar got stronger, therefore gold prices got weaker. And now what we are seeing is that the pair is kind of approaching this pivot zone. It's been testing this pivot zone at the moment. In the pivot zone, actually I'm going to use a horizontal array. Right? So the pivot point at around 1214 or 1215 is what the gold prices are trying to approach, and this is one of the levels that I would definitely keep in mind when it comes to gold trading. So basically what I'm trying to say is that there is a possibility that the pair will hold at this pivot zone, and it is not able to break below it. However, if it does, that is when we could see further drops towards this target, which is a previous high. So previous highs are always very, very strong in terms of support, and this has been tested multiple times. This level, about 1180 to 1183, this zone, right? So we had a reversal over here. We've had the pair testing it over here a bunch of times, right? And also this zone, not quite that, like it's a little bit lower, but well, basically this zone seems to be an interesting target for gold prices. So if the Fed does go ahead and raise interest rates in June, we could easily expect the gold prices to drop back eventually towards 1183. However, one other thing you want to remember when it comes to price of gold and US dollar is that, well, this is an election year. There is a lot of uncertainty going on, and in the U.S., the Democratic Party still doesn't know who's going to be the nominee, and on the Republican side, we have Donald Trump, who may really affect the economy in a negative way, especially when it comes to trading with other countries and a relationship with China, and that could also up until November, we're going to see a quite enormous amount of volatility, both in the prices of gold and the US dollar. So you do want to keep that in mind. So one trading strategy here for gold traders is waiting for a break below this level and then targeting. I wouldn't go all the way down to 1180. I would actually target a little bit higher up just to be safe at 1190 and call it a day and wait for the next signals, right? So there's our bearish scenario for gold. And when it comes to our bullish scenario, I do want to take a look at a little bit longer period. So gold historically has been very high up before. The highest it's been versus the US dollar in the recorded history is around, well, 1919 or 1920. And but it has also been, it has experienced very low prices. I mean, just a decade away before I go back in the 2000s, the price of gold was very low at the 200 level. So right now we're right in between the historic high and the historic low when it comes to gold prices. And I'm going to try and see if there is a Fibonacci over here. Yep. So this is what we can use for the levels that we can focus on when it comes to, oops, where did it go? Okay. So as you can see, well, the 50% Fibonacci level is really coinciding at the this bottom that we have, which is not a coincidence. Probably a lot of traders saw it, and psychologically they decided to shift the market. The pair wasn't able to break above it. So right now we're really in the middle of the bottom and the low when it comes to gold, and it is over here. If you look at this monthly candlestick, there is an interesting development. Even though last month in April we had a very bullish year for gold after a spinning top, this year we have an even more bearish months for gold. But I mean, we still have a little bit left when it comes to May. We have another 6, or actually like 3 more actual trading days left in the month of May. But so this also backs up our strategy of this pivot point right over here, because if we end this month lower than this level, so this bearish candlestick, if this is bigger than the previous bullish candlestick, that will create a bearish engulfing. So not only we would see a break below that pivot point that I talked about before, but we would also see another reversal candlestick pattern, a bearish engulfing. So that would be 2 technical signals as to the direction of gold, which will also signal more bearish moves. However, if we end it right around here, if it's not majorly larger than the previous month, this candlestick, we could, the level that we really have to keep in mind is $12.99, right over here. And we could see a range a little bit around here. And if it, as you can see, so this area is kind of a consolidation right now, right? In the monthly chart since 2013, actually. The prices will have basically ranged between 50% Fibonacci, and they haven't quite reached the 23% Fibonacci. So a bullish scenario would be a break above $12.99, in which I wouldn't target 20% Fibonacci per se. I would target, you can see here we had a channel going down. So if I were to show the channel on the chart, well, let's go with the trend line, right? Oh, there you go, parallel channel. So this small channel over here, between and a angle trend line, right? So this is the channel that the pair broke above. So at the time when we broke above this channel, that was a bullish signal. So a very safe bullish target right now that gold prices are really low, are approaching a pivot level, would be any high along the higher level of this channel. So that would basically be, where are the trend lines again? Either this high, right? Or if you want to be a little bit more conservative, this high at 1333, right? So these are the level that you want to keep in mind. I wouldn't go crazy and target the 23% Fibonacci when it comes to gold at the moment, because we have a little bit stronger indications for a stronger US dollar, and we still, I mean, unless Trump becomes president, we can't really see a reversal for that towards the end of the year. As I said, the bearish signal is a little bit stronger. We have more to support the bearish strategy, and in a very long run, we could either use this lower band of this channel as our resistance level, as our support level, or the 50% Fibonacci level at 1035 as support. Pivot line, one more time, is at 1233, between 1233 and 1119, and then we have our different levels of resistance at 1299, 1333, and 1400. All right, so here we did it. We covered gold, and it is interesting that I'm getting some more attendees right now. Did anybody think that the webinar is going to start right now? I hope not. The webinar is actually just ending. Hello to everybody joining us right now, and apologies for, I don't know, maybe there was a confusion. Today we covered metals and dollar, the correlation, the inverse correlation between the precious metals and dollar, and what it means for different currency pairs, and we answered some questions as well. So there is something wrong with the calendar invites. I will keep that bring that to the attention of Orbex staff. I did see that as well when I wanted to join the webinar. It said the webinar will start in an hour, and then it's only started. So I was a little bit confused. It is, yeah, I'm sorry to hear that. We have people joining us right now and thinking the webinar is just starting. You can watch the recorded version of this webinar on Orbx.com. I think this is a problem with GoToMeeting. Their calendar is messing up a little bit, the time zones, and it's supposed to be 5 p.m. GMT. So the next time, no matter where you are, just no matter what the GoToMeeting tells you, remember that my webinars start at 5 p.m. GMT, all right? So just convert that on your, you can go online, and if you have an iPhone or phone, it will tell you what exactly that converts to your time zone. And hopefully I'll see you next time in the webinar. For this time, definitely go and check the recorded webinar. And when will I'm going to convert this webinar right now. I'm going to send it over, and I believe the recorded version of this is going to be available by tomorrow. And feel free to contact Orbx and tell them if you go to Orbx.com, and you can either live chat with them or email them directly at info@orbx.com. Tell them about the problem that you had. And yeah, so it is UK 5 p.m. That is the time that our webinars normally start. All right, and they should send you the recorded version of the webinar. Also, if you follow them on Twitter, they do send the Twitter out. Thank you so much, everybody, for joining us today, and I'll hope to see you soon. All right, invest responsibly. Bye.